Hello and welcome to another video in our Taking Care of Business series. In another video we examine the pros and cons of structuring your business as a sole trader or partnership. But in this video we examine the more complex structures, companies and trusts. Let me say up front, it is almost impossible to recommend a particular type of business structure without a solid understanding of your business, your industry, your family structure and your financial situation. As such, when discussing business structures, we always take into account issues like asset protection, tax minimisation, the potential admission of new partners or investors, compliance with all legal requirements, and eligibility for future discount capital gains concessions. In most cases, the choice of business structure is a compromise based on the relative importance of each of these issues. Let's start by looking at a corporate or company structure. A company is a separate legal entity distinct from its shareholders who own the company. Companies are granted legal status to enter into contracts and can sue and be sued. They are governed by corporations law, which is administered by the Australian Securities and Investments Commission. There are different types of companies, but the most common is a company limited by shares. They provide a form of asset protection with limited liability, so the personal assets of the individual shareholders are separated from the debts of the company. A company lodges an annual tax return and the profits are taxed at a flat rate of tax. The tax rate for companies with an aggregated turnover of less than 25 million is 27.5%. Next, let's look at a trust structure. Unlike a company, a trust is not a separate legal entity. Instead, it appoints a trustee who is required to undertake all obligations and transactions on behalf of the trust. The role of trustee carries legal liability for the activities undertaken by the trust, so trustees are often companies to limit liability. There are several types of trust, including discretionary or family trust, where the trustee has a discretion on how the trust income is to be distributed each year to the qualifying beneficiaries. They don't have to make income distributions in any set proportion each year, so income splitting is a major advantage. Trusts also provide a mechanism to pass family-owned assets to future generations. A unit trust is a form of fixed trust where each beneficiary or unit holder is entitled to trust income and trust property in proportion to the number of units they own. A trust must lodge an annual tax return and will generally only pay tax if the net income is not distributed to the beneficiaries. Each beneficiary will be responsible for income tax in their own right. In summary, your choice of business structure is a very important decision. To recommend any type of structure, we really need to sit down with you to discuss issues like asset protection, tax minimisation, and the likely admission of new investors or partners. If you're looking to start your own business or want to restructure your existing operation, we urge you to consult with us regarding the various types of structures. Until next time.